My name is Joshua Harmon Sr. I'm a real estate investor and also a real estate agent with Keller Williams Platinum Realty in Fort Smith, Arkansas. The purpose of this channel, whether you're watching this on Facebook, YouTube, Instagram, or whatever social platform you're watching this on, the purpose of this channel and purpose of this video is to teach people how to invest in apartment buildings. Most people think investing in apartment buildings are just for the rich and people who were born with money, but that's not true. With a certain skill set and a certain knowledge base, anybody can invest in apartment buildings. Does that mean that everybody will invest in apartment buildings? No, it will not. Not everybody is willing to put in the work to learn and then also implement the things that they're learning. So I'm going to be posting videos every Monday and Thursday. So everybody can expect videos on my Facebook page, YouTube, and Instagram every Monday and Thursday about apartment investing and just teaching you different strategies that I've learned from others and also that I've implemented myself. I own a 8-unit, a 4-unit, and a duplex. So by no means do I know everything, but I read a lot and I listen to a lot of podcasts and I read a lot of books. So I have a lot of knowledge up here that I haven't implemented myself yet, but I'm working towards it. And hopefully by watching my videos, you guys get a chance to follow along my journey and watch me scale my business exponentially as well as it comes to real estate investing in apartment buildings. So today we're going to talk about how to invest in small apartments. And the first question is, what is considered a small apartment? I know some investors that 100 units is too small for them. If they're going to come into a market, they need at least 150 to 200 units. But just talking the normal investor, a small apartment, in my opinion, is anything between 2 and 20 units. So anywhere between a duplex all the way up to a 20-unit complex. And that's what we're going to focus on today and teach you how to invest in a small apartment building. First and foremost, education. So before I ever bought a property, I probably read 40 to 50 books. Throughout high school, I maybe read 5 books. So 50 books for me was a huge deal. And now I probably read a book every 2 weeks. So, or a book a week. So that's really good. That's something that's become normal for me now. But when I originally wanted to invest and I didn't have anybody to ask, there was nobody around me who really invested in apartment buildings. I had to learn from somebody else that I didn't know. So reading books was my first step at that. Some books that I recommend about apartment investing: Rich Dad, Poor Dad, which isn't specifically geared towards apartment investors, but it teaches you a lot about wealth, money, just the values you need, the core, the base that you need to be an investor. Rich Dad, Poor Dad has pretty much everything you need to know about that. When you want to get more specific and things you can actually implement, Crushing It in Apartments and Commercial Real Estate was a great book that I read. Talked a lot about specific case studies and things that the author did on his own. And he did great, and he taught me a lot in that book. And I still implement. I read that maybe 2 years ago, and I still implement some of those things today. It wasn't just fluff. It wasn't just Rich Dad Poor Dad can have some fluff in it because it's just trying to build the values. But Crushing It in Apartments and Commercial Real Estate talked a lot about actual things that you can implement. Another book that I read was How to Make Big Money in Small Apartments. Another very specific book talked a lot about strategies that you can implement, how to find properties, what do you do when you have the property, just things you're going to run into as a manager and as a property owner. So that was another great book as well. And I'm sure there's a lot of other ones as well, but those are just a few that I recommend to start off with. Also podcasts, which is free if you have an iPhone. Wheelbarrow Profits is great. They talk about buying right, managing right, and financing right. So it teaches you how to finance properties, how to buy properties the right way, and how to manage them the right way as well. Great podcast. And they're not just for the large investors. It's pretty much for anybody can listen to that podcast and take some away. The Bigger Pockets podcast, they also have the largest platform for real estate investing. They have a blog and different things online, but the podcast was great for me. That's actually what I started off with as far as listening to podcasts. That may have been the first podcast I ever listened to, quite honestly. But it was a great podcast as a beginner to learn a lot about the basics of real estate investing. When you want to get more technical and a lot more, you get more of a deep dive, I would listen to the apartment building investing podcast by Michael Blanc. He's based out of Virginia, I believe. And I also went to his, he had an event in Virginia as well that I went to, and it was great. But the podcast, it's free. It's an awesome tool. He talks to tax people, managers, investors, and it's great. I think that's something if somebody wanted to get more detailed information. The apartment building investing podcast and Wheelbarrow Profits are the two more detailed ones. Bigger Pockets is more for beginners, but you have to have that base. Like, you don't want to walk away and just go to, or you don't want to just go to all the advanced stuff and forget about the base. That Bigger Pockets and Rich Dad Poor Dad. So when you're beginning, I would start off with those two things. Number two, after you have the education that you need to get enough confidence, because that's what you're going to need. Education will give you confidence to actually go out to the market and actually talk to a property owner. The way I found properties from the beginning, and the way most people find properties, number one, through realtors. So I am a real estate agent in Fort Smith, Arkansas. I can help anybody buy properties across the state of Arkansas, and I will be getting my Oklahoma license soon as well. So I'll be able to help people in Oklahoma. But realtors, as a buyer, you do not have to pay them a fee. The seller pays the fee. Now, depending on your buyer agency agreement, but on most cases, the selling agent pays the fee. So you get free advice. You basically get a free foot soldier who can go out in the market, check the MLS, talk to owners, and do different things. So you don't have to do it on your own, because if you have a full-time job, more times than not, you don't have the time or the expertise to just go out there and just find a property. You can leverage a realtor to go out there and do that work for you. The way I found my first 8-unit property was off market. So what I did is I drove around town. It's called driving for dollars. Most real estate investors use that term. So driving for dollars. I drove around the entire Fort Smith, Arkansas, looking for properties that were distressed, but we're in good areas that we can add value to. I did not have the money. I did not know if I can get the financing, but I knew I had the hustle to go find a property. So what I did is I took up my iPhone and I took down the address of every property that I thought was in a good area but looked terrible. And because I knew it would probably be a lower barrier to entry than a property that looked great in a great area. You may not be able to get those properties as a beginner. So I found a property, if you're from Fort Smith, Arkansas, it's right near Northside High School, and not too far from downtown Fort Smith. So kind of a area that most people may not invest in, but I thought it was great because it stood alone. It looked like it needed a lot of work. It weren't very many cars out there. So what I did is, with these maybe 10 or 20 properties that I found, I went on the tax records I went on the county records and checked the name and the mailing address of every owner. And I typed up a quick letter basically saying that I want to buy your property as is. We can close in 30 days. I mean, that was the gist of what I said. I didn't have anything fancy. I signed it and I sent it to these owners. And I probably had 5 out of 20 people get back to me. 4 of them said not right now. And one guy actually said yes, the 8-unit property they ended up buying. And I basically sent a letter for 50 to 60 cents. I mean, that's really what it cost me. I basically got my first apartment complex. The barrier of entry was 69 cents, because I didn't put any. I actually brought in a partner, so I didn't get the financing. I didn't bring the money. All I did was send the letter for 60 cents, and I got an 8-unit apartment, my first property. So there are great things that could come out of it. Is that going to happen for everybody? No, but that is something I recommend everybody doing, is being proactive, getting out in the market. By driving around and looking at different properties, you'll start to learn a lot about the area that you're in, the rental market, because a lot of people who live in cities don't look at properties through the lens of an investor. You look at it as a consumer. So you really don't know, market rents. You don't know, cues to look for of, how you can add value to a property. Most consumers or renters are just looking, hey, it's nice, it's got a pool, it's got a clubhouse, it's great. But investors may not look at it as a great property because they may not be able to get the return they're looking for. As an investor, most of the time we're looking for a value add opportunity. So we're looking for that property that may not look as great, may not have as many cars out there, so we can add that value and reap the benefits on the back end. So by driving for dollars, doing some off-market marketing, sending some letters and different things like that. I think that'd be great for anybody to do, as well as find a realtor. Number three, relationships. So whether you're going to a local meetup, whether somebody at your church, somebody you went to school with, relationships that's everything in real estate investing, because no one can do it on their own. There is not one property owner in America who does everything on their own. They don't do the management, the repairs and maintenance, the finance. And you have to have relations with people. And by having relationships, you may get the heads up on a property that's coming to market soon that no one knows about. So relationships mean a lot. So relationships, off-market marketing, and realtors are the best ways to find properties. Another thing, why you're looking for a property. So once you find that property and you're in conversations with the owner, three terms? Three terms that I would ask for is one, a financing contingency, business entity approval, and satisfactory inspection. And due diligence. So financing contingency basically says if I don't get financing, that I can get out of this contract. Business entity or business partner approval basically means if my partner doesn't think that this is a property we should invest in, I get out of the contract. Three, satisfactory inspection. So that means that when you do your property inspection, let's just say all the plumbing is terrible, it's going to cost you $50,000 to repair this 10 units plumbing. Depending on the price, you may have to walk away from that deal, because that may take all of your your proceeds to be able to fix this property up, whether it's coming from the bank or out of your pocket or your partner's pocket. You may have to walk away from that deal. And if you don't have that satisfactory inspection contingency, you may not be able to get out of, or you may lose your earnest money. And then due diligence period. So a due diligence period basically gives you, a typical due diligence period is about 30 days, but I've seen people get 90-day due diligence periods, depending on the size of the property. And basically that just gives you time to, look at leases and, look at property managers, talk to accountants, just do everything needed to get this property closed. And those are four contingencies that I would ask for while I'm looking for a property. And if I can't get those specific terms, a lot of times, depending on what market, if you're in a Dallas or one of the Florida markets, you may not be able to get those terms. But if you're in Arkansas, you may be able to ask for all four of those and get it, because we're not as competitive as a market as Austin, Texas, Dallas, Texas, Miami, or Tampa, or something like that. Number three of how to find or how to invest in small apartments is find the financing. And some people may say, well, we haven't talked about the money yet. But I think finding the financing is maybe a little bit more important than finding the money just yet. Because a lot of times we're looking for value add opportunities. And a lot of times you may not need any money to buy these deals, or not very much. I think finding the financing lines yourself up and aligns yourself with the bank. Finding a bank that aligns you with your interests and your goals, I think that puts you in a perfect position to be able to ask somebody for the money. Say, look, I found the property, I found the deal. I found the financing. I need 10 grand to close on this deal. And the bank is going to finance the construction cost. That looks better than you coming to an investor and saying, hey, look, I found a deal. I don't have financing. Just, I need you to partner with me. They may not be as willing to do that just because, you don't have you don't have everything aligned already. So finding the financing, I recommend on small apartments going to local banks or credit unions, just because they'll give you better loan terms than maybe a national bank like a Arvis, Wells Fargo, Bank of America, Wachovia. Those type of banks, those are national banks. So they don't have the kind of terms that a local bank can give you, like 20-year amortization, which allows your mortgage to be lower and allows you to cash flow a little bit better. And also those national banks, they may not give you the interest rate that you want to have, that you want to get as well. And those fluctuate depending on what's going on in the market. So, you have to look out for that. And I think local banks and credit unions, you align a little bit better with them rather than a national bank. And when you start getting into properties over 50 units or at least $1 million balance, then you need to start talking to some of the agencies, Freddie and Fannie, and they'll give you the terms. They'll give you 30-year amortization, which you can cash flow crazy. You can start looking at interest-only loans, which you don't pay any principal interest. during those interest only periods. But when we're talking about small apartments, I would recommend going to a local bank or a credit union. Even if you find a local bank that you align with, maybe you've been going to this credit union for 15 years, you've had a savings and a checking account with them. They're going to give you great terms, but they may not give you everything on the front end on their first offer. You may need to shop a few lenders that you don't have relationships with. So go to that first bank that you have a relationship with, that local bank you have a relationship with. But once you get that loan offer, you want to shop that around to different banks. Because once they see the offer, those other banks see that offer that you have on the table from your bank, they may offer you something better. Or if they offer you something better, or even if they don't, you could take that back to your bank and say, hey, look, they may not be offering me the terms I'm looking for, but I'm looking to do something else with them, and they promised to give me better terms of the future. Can you do a little bit better on the interest or better on the terms? I know you're saying you're going to do 15-year amortization, but they said they could do 20. Can you give me 20-year amortization so I can cash flow a little bit better? And that's just how you shop it. They won't get offended or anything like that because that's just business. At the end of the day, they understand it's business, and they have to work for the business. I don't think they'd be offended at all. And in the past, I haven't had lenders that have been upset with me for shopping rates and asking for a better rate based on what somebody else gave me. So that's what I would do when you're looking for financing. The fourth thing is find the money. First and foremost, when you're looking for money to invest in your deal, the lender's already told you how much money you need to bring to the table, or two, they've told you can't get financing. So in this case, it's either find the money / find a partner. So I'll just say find a partner on this one, not find the money. The number one thing about finding a partner is relationships. So my first deal, my 8 unit, like I told you guys before, I found the deal, got it under contract. I knew I couldn't qualify for the financing. I did not have the money, but I was completely transparent with the seller. I told him, hey, look, I don't have the money to close this deal, but I'm going to bring in a partner. Will you give me time to go find a partner? He said, yes, if you give me a $500 earnest money deposit. So I gave him the $500 earnest money deposit, and I looked on Bigger Pockets, found a partner in 2017 that I still invest with today in 2019. And we've actually just closed on another property together, a duplex, that we're going to add value to as well, since we did so well in the 8 unit. But the relationships, you want to align yourself with people who have the same interests as you. Maybe it's somebody who wants to invest in apartments, but they live in a smaller town and they don't have the market knowledge to get into your market and buy properties. So they need you because you have a deal, or they need you because you have the financing in place already. And you have the deal, you have the whole infrastructure set up, and all they need to do is bring in the money. That may be attractive to some people. But typically, yes, that is the way you want to do it. You want to have the financing, you want to have the deal. Otherwise, why do they need you? They may just pay you a fee and tell you to go away. We'll take the deal over from here. But if you have the financing and the deal, they'll want to just align themselves with you because you have the infrastructure set up, and they may just want to invest with you. But I was pretty bold, and if anyone knows me, I love to sell people on things, and I love apartments. So I talked very educated. I spoke very educated. And we were able to align ourselves and buy this property together. And it was all through a relationship. We met a few times for lunch, met for coffee. Even though I don't drink coffee, I still went out there to the coffee shop with them, and we met at the property. So we probably met 4 times before we decided to actually invest with me. And after we built that relationship, I know we'll do more deals together. So you guys have to build relationships with people, align with people who also have the same interests as you. Even if they don't have the same interests, they have the money, and they need to invest that money. Hey, look, we've known each other for a long time, and I have this deal that I'd like to show you and see if you'd be interested in investing with me. These are the returns I'm projecting. You need to be educated. And that was the number one thing I talked about was education. You have to be educated on your market, the asset class, the team members you need to have in place in order to run this deal efficiently and get your partner, the returns that they're looking for, and that you're promising them. So relationships mean everything. Or number 2, you could just use your own money. So find the money or find the partner. You could just use your own money. But the more partners you bring on, the more properties you could buy, because you can scale and you can expand yourself. So if you have a partner, let's just say you have 10 or 15 grand, and you use a partner to buy a deal, you can now use that 10,000 somewhere else and buy another property. Yeah, so using your own money is probably not the best way to scale, but that is one tried and true way to get into small apartments. So either way, through a relationship, an apartment partner, or you just bring the money on your own, either way, that's how you would find the money for a small apartment. The number 5 thing you need to do is due diligence. And this may be the most important part, because up to this point, you probably haven't toured the property. You probably haven't looked through all the leases. You probably haven't looked through the owner's tax returns for the entity they used to buy the property. You probably haven't had a property manager walk through the property with you, an inspector to walk through the property with you, a construction manager to walk through the property with you. So these are all things you need to do through due diligence. And this is why it can take anywhere between 30 and 90 days to get this complete. Until you're savvy enough, everyone doesn't use an actual property inspector, but until you're savvy enough to walk through a property and know that the cabinets need to be replaced, know you need to look at know how to look at fuse boxes, know how to look at plumbing, know how to look at roofs. Until you know how to do all those things and you feel comfortable, and I mean, it's just so you need to hire an inspector, because you will lose money. Because if you buy a deal projecting that you're only gonna need $50,000 to renovate this 8-unit apartment and bump rents $100 per unit, but then you get there, the roof's leaking, they got old plumbing, or they got knob and tube electric or whatever, yeah, it's gonna cost you money, and you're gonna lose money on this deal. I mean, you just are, because depending on what comes up in that after close, you may not be able to sustain or cash flow enough. You may have to get the property back to the bank. So due diligence is so important, and until you're savvy enough to see all those things and know what to look for at an apartment building. For example, I mean, a property built before 73 may have lead-based paint. It may have asbestos, or it may have, it could have anything. So you need to have an inspector or a trusted advisor come with you until you're savvy enough to walk through the property on your own. And I feel like I'm savvy enough to do it after walking through so many properties over the course of the past 2 years. But I will tell you, 2 years ago, I had no clue what to look for. I had no clue what construction costs would be, and I wasn't able to make an offer until I had the construction manager, property manager, another partner, all these people walk through a property with me. But I could do